Hey there, traders! Thanks for being here. Today, I want to share a real trade example that highlights how I used a put broken wing butterfly strategy in a volatile market, particularly when gamma exposure GEX was negative and implied volatility IV was high. I hope it'll give you a clear picture of how to navigate this kind of environment with a small account and still manage risk effectively. And I'm able to do all of this by relying solely on my own options know-how and the options indicators available on Tradingview to guide every decision. Let me set the stage. The market was choppy with no sign of IV cooling off. Both IVRank and implied volatility were up, so premiums were pretty rich. At first, call options had been pricey, but suddenly the skew flipped and put options became more expensive. That was a big clue that sentiment was leaning bearish. My TanukiTrade options indicators also confirmed there was growing dominance in put options. Given the high IV and potentially quick moves in negative gamma exposure profile until selected expiration, I went for a short duration, about 11 days until expiration. In terms of capital, I kept my buying power requirement at around $1,156 and capped my maximum risk at about 2% of my small account, roughly $300. With that constraint, I decided to open two put broken wing butterfly for small debit, flat negative net delta, so I could stay within my comfort zone. From there, I kept a close eye on GEX, which was signaling negative values. This usually means there could be more downside pressure, but there's also a point where puts might provide some level of support. At the open, my indicators suggested support might lie in the 645 region, so I built my butterflies with short strikes slightly below the highest negative put wall. Short put delta was at 30. My overall positioning was slightly negative net delta, so if the underlying inched down or even just moved sideways, I'd likely be in good shape. And since put skew had firmed up, the payoff range for a broken wing butterfly made sense, plus the risk was capped. After about 3 days, I noticed my short put strikes were getting uncomfortably close to being in the money because the price was drifting lower. GEX readings suggested more downside was possible and that put support might be further down than I initially thought. To handle this, I opened 4 additional put broken wing butterfly positions at lower strikes. This expanded my profit zone and helped neutralize the heavier positive delta that had started creeping in. Of course, adding those positions pushed my buying power usage up to $3,488. At one point, I was down about $73 on paper, but with the time decay working in my favor, I was confident the position would turn around if the market didn't plunge straight through support. There was also a small concern about early assignment, since my older short puts was in the money, but in my experience, that's pretty rare for liquid, large cap stocks until the final days before expiration. About 8 days after opening, with 3 days left to expiration, I decided to close out in profit. By then, the market had bounced off that support area and was moving sideways to slightly higher. My short options had decayed significantly, and I was sitting on more than 10% return relative to the $3,000 I deployed, which is a solid gain for less than 2 weeks of risk. I chose to exit in 2 parts, mainly because I'd already hit my profit target of 5–10% and didn't want to push my luck with any late breaking news or assignment risk. So here's what I take away from this. First, in a market with high volatility and negative gamma exposure profile, shorter duration strategies can be very effective because you get faster time decay and it's easier to keep risk in check. Second, when put pricing skew appears in a stock that normally has pricier call options and the market starts looking more bearish, a put broken wing butterfly with wide and flat negative net delta for small debit can be an especially flexible approach that provides a wider margin for error if the price drifts or chops sideways. Third, it's crucial to scale or adjust positions as new GEX or volatility data comes in. Don't be afraid to add or remove trades if it aligns with your risk rules. It's crucial to watch your net delta and bring it closer to zero if your trades have started leaning too heavily in one direction. By neutralizing excessive directional risk this way, you can better manage volatility and maintain a more balanced overall position. And of course, if you hit your profit target early, there's nothing wrong with closing up shop and locking it in, especially if the short puts are hovering in the money and the risk of early assignment is on the table. I hope this quick walkthrough helps you see how to combine gamma exposure signals, IV analysis, and a well-structured butterfly strategy to trade more confidently, even on a smaller account with our indicators on Tradingview. Take care and happy trading. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.